In today's video, we're going to show you how you can potentially make your Social Security income 100% tax-free. We're also going to show you common mistakes that occur that could cause more of your benefits to be lost to taxation, which means less income for your retirement. As always, my goal is not to just show you this, but to help you understand it. So in order to help you learn it and understand it, we have to start with some very basic terms of how the IRS calculates what part of your Social Security benefits is potentially subject to taxation. So as I go through these, don't be intimidated. If you're not a tax person, we're gonna have some examples at the midpoint of this video where it's gonna kind of all bring it home and help you really see it and hopefully learn what all of this more technical stuff here kind of means. But we're gonna keep it high level, super simple, and you'll have the facts. First thing we have to do is calculate your provisional income. So in retirement, your income is typically gonna be comprised of IRA withdrawals, your investment income, maybe a pension. So that's the first step, calculate the gross income. Then we add in any non-taxable interest like muni bonds. And then finally, we add 1/2 of our Social Security benefit. So we add all this together and then we get our provisional income. One quick note about muni bonds here. So even though municipal bonds are federally income tax-free, the interest that they pay, in many parts of the tax code, you have to take that tax-free interest and from an accounting standpoint, add it back into your total income so it goes on top of it. So even though you're not paying income tax on that interest, you have to add it back in, which can then increase your provisional income or something that's known as modified adjusted gross income. And this can have ripple effects across many aspects of your retirement, such as potentially increasing the tax you pay on investment income, your Medicare premiums, many different aspects of the tax code. So it's just a side note there, but something to be aware of. So that's step one, determine your provisional income. Step two is we now have to compare that provisional income to the thresholds, whether you're single or married filing jointly, that the IRS gives us. So you don't have to memorize these. We're gonna have a link in the description to a blog post on our website where we'll have all of this written down so you can easily reference it in the future. But if you're single, your first threshold is less than $25,000 of provisional income. If that's the case, 0% subject to tax. 25 to 34,000 of provisional income, 50% of your benefits could be subject to income tax. And if it's greater than 34,000, up to 85%. Here are your thresholds if you're married filing jointly. So it's less than 32,000, between 32 to 44, and then greater than 44,000. One important note here is that these numbers right here, 0, 50, and 85, that is not the tax rate that you'll pay on your benefits. That's just how much of your benefits are then potentially subject to income tax. And also it's not a flat 50%, it's up to 50%. So meaning if your provisional income comes in here at 28,000, it's kind of dragged in gradually, meaning that 28,000, not all 50% of it would be subject to income tax. There's a gradual kind of moving in, phasing in of that income to a different percentage. So it might be 45, 43, something like that. Okay, so here's your pop quiz. We've went through the step one and step two. Now we have a real world example. So I'm gonna give you a second to think about it, and then we're gonna kind of show you, but the goal here is again to help you to learn, to help you understand. So we have a married couple, 67 years old, with $40,000 of Social Security income and $20,000 of IRA withdrawals. How much is their gross income? And then how much is their provisional income? Okay, hopefully you took a second there to think this through and then come up with what provisional income is. So again, we take the IRA withdrawals plus 1/2 of the Social Security benefits. So 20,000 and 20,000 equals 40,000. So that's our provisional income. Now, pop quiz number two. What percentage of your Social Security benefits are now subject to income tax? Okay, hopefully you got this right, but you have to go back to step two and compare that provisional income to the thresholds. But kind of a trick question here because you also had to pay attention to if they were single or married. In this example, I said that it was a married couple, 67 years old. So you come back to step two to compare to the thresholds. We see 40,000 of provisional income falls into this up to 50% subject to income tax rate. So now that brings us to what's known as adjusted gross income. So we had $20,000 of IRA withdrawals. The provisional income calculation told us that 50% of our benefits were subject to income tax. So again, 50% of this 40,000 now brings it to 20. So 20 and 20, our adjusted gross income is now $40,000, AGI. This may be a term you're familiar with from talking to your CPA. Step 3, now we have to take your adjusted gross income and we subtract out, for most of you, the standard deduction. Although now with the passage of the new law, many of you may be itemizing because the itemizations have increased. So we'll see more of that in the coming years, at least for the next 4. But we're gonna just work off the standard deduction today. So that's the next step. You have your adjusted gross income, your AGI. Now you subtract out your deductions. Okay, so 2025, here is a table of the standard deductions. Also, this is gonna be in the blog, so you can link back to the website from the link in the description, so you don't have to remember these or go surfing on the internet to try to find them. So we're looking at a married couple over the age of 65. So they have a base standard deduction of $31,500. Then each spouse gets an additional $1,600. Then because of the One Big Beautiful Bill, the new tax legislation that was just enacted, there's what's known as a senior bonus. So it's $12,000, but as you remember, President Trump campaigned for about tax-free Social Security. Well, they weren't able to get that to score, according to the Congressional Budget Office, appropriately to pass the legislation and to get both sides to come together and agree on the bill. So what they did is they put a senior bonus deduction in for those that are over the age of 65. And what it ultimately does is for the wide majority of people, you will not pay tax on your Social Security. But if you have assets accumulated, if you have wealth, then you may be outside of that majority of people who won't pay tax. And so now we're talking about retirement planning because we're going to bring all this back to your retirement accounts, to the taxes that you may or may not pay, and help you understand the bigger picture of retirement planning. So now you may be wondering, well, what if I'm 67 years old and my wife is 64 years old? Well, only the person over 65 gets the $1,600 deduction, and only the person over 65 gets the $12,000 deduction. So both of you would get the $31,500 if you're married filing jointly, plus an additional $1,600, so that brings us to $33,100, and then plus another $12,000, which brings us to $45,100. If you were both over the age of 65 or 65 plus, so at least 65, your standard deduction is $46,700. And you can see if you're married and under 65, single, you can pause the video, but again, we're gonna link in the description below back to our blog on the website where we're gonna have all of this written. You can save it, reference it for the future if you need to. Okay, back to step 3, subtract out your standard deduction. So now that you understand what those are for 2025, remember we have an AGI, adjusted gross income of $40,000, so we subtract out that standard deduction. So 40 minus 46,700 is negative $6,700 of income, which means your taxable income is 0. Now, because that's a negative taxable income, it doesn't mean you get to deduct that in future years or you get some type of refund. It just goes away and you just pay 0 tax. So now the bigger picture here. We have to understand the retirement income pie. So this is part of income planning. This is part, if you're in the pre-retirement phase and looking forward, this is a lot of preparation, especially that we do for children of clients or clients that we have that are younger than retirement age. We want to typically diversify the composition of our retirement pie. This gives us more flexibility to choose where we take our income from in retirement, and therefore maneuver around the tax code to pay as little or as much as we choose to based on what we want to do now, but also how it impacts us in the future. So here's your retirement pie, and I want to communicate this in a way that really focuses on Social Security and how more or less of your Social Security can be subject to tax. So most people in retirement are going to have some non-qualified investments. So non-qualified, it just simply means it's not qualified because your retirement accounts are qualified. Your IRAs, your 401ks, they're classified as a qualified asset. Just the best way to remember it is you qualify to pay tax, kind of tongue-in-cheek there. Non-qualified is your savings accounts, your investment accounts that are not inside a retirement account. So this would not be that uncommon of a breakdown, but let's say our income, this is our income pie. So 10% of our income comes from non-qualified investments. So interest, dividends, etc. Say we have a pension that equals 20%, IRA withdrawals, 30% of our income pie, and Social Security, 40% of our income pie for this example. So the thing to understand is that the larger pieces of pie that are here, the more the IRS is going to want a piece of your Social Security slice. So as these get bigger, especially the pension or the IRA withdrawals, your slice of Social Security pie gets smaller. Pensions are great for guaranteed lifetime income and security and having income come in that you can rely on, but they're really, really bad for tax planning because when you have pensions, it eats up a large part of your Social Security pie from a taxation standpoint. Large retirement account withdrawals really destroy the potential for your Social Security to be tax-free. This is why we need to look not just at the impact of taxes and income today, but we need to have that visibility to see what is the impact on our retirement income and taxes in the future. Bringing that all together is what we call the retirement success plan. So I want to bring this all together from a retirement planning standpoint in the decisions that you have to make and really hopefully connect the dots of how they're all interacting and what it means for you. So you have to decide with Social Security when to take it, right? Retirement accounts, not only when to take it, but how much to take it and should you convert. By convert, I mean move it from the IRA to the Roth, which is tax-free. Then from your non-qualified accounts, when to take it and how much. So these decisions, all of them impact your account balances, your taxes, your income today, but they also impact all of those components of your retirement in the future. We see here, this is what I call visibility. So this is what we do. We try to create visibility so we can make better decisions. When you can see the impact of when to take Social Security, how much to take from your retirement accounts, when do I convert or not, how much, what about the non-qualified accounts? When I can see all those different variables and making different decisions, how they impact me now and into the future, that's what we call the retirement success plan. So that's the RSP. That's what we're trying to do with retirement. That's what we do for clients. If you're working on this on your own or you have another advisor, we believe these are the elements that lead to a successful retirement by putting more money in your pocket and paying less tax over time.